All right. I did a hour plus long Opex effect podcast today. And the reason I bring that up is because I highlighted a lot of the interesting relationships that we've been seeing over the past days and the weird things that have been going on. And I wanted to start off this this is my topic number 2 with a few of these. So let me pause this real quick because I always like to give you guys a heads up of some of the key things. Now, most of you have already known, about these concepts and these ideas. And what I've framed this at, and you've probably seen me work through this in real time, is this idea of correlation spasms. And the way that I frame this is that we've had record low correlation. We're all aware of that, right? Here's the record low correlation, 1 month low correlation. We've had a 3 month low. Record low and 1 month correlation. Record low and 3 month correlation. Those correlations look forward in time. And I said, because those correlations are going down, I think vol will go down as well. And we hit multi-year lows in realized vol last week. And then on Wednesday, stuff started to get a little weird, right? And as I outlined in the founder's note this morning, vol started to get a little bit shifty. And I've called that a correlation spasm. Now, why does that matter? Well, if you look at, and we covered this in depth before on our Wednesday note, this was the returns from Wednesday. NVIDIA, Apple, Microsoft are 20% of the S&P 500 and 25% of the Qs. You also have extremely giant weightings of NVIDIA in the XLK and the SMH and all those other things, right? So we have these 3 stocks that dominate the S&P 500 and the NASDAQ. And the argument with that, with most people, is they go, look, breadth is poor, and if the market rally broadens out, that's great. And I totally agree with you. Widening breadth is great. As you can see in this chart, this is the second highest percentage the top 10 has been since the only year that's different is 2007. So we have extreme correlation or extreme concentration, extreme correlation. And if you look historically, this is realized correlation, meaning measuring what has happened as opposed to using an option to look forward in time. You can see this dispersion, which is how much the individual components are moving around, is as high as it's been in recent years, really in the last decade. In fact, if you look at dispersion, which is this x-axis here, so how much are the individual components moving around, we're only about half as high in dispersion measurements as we were in the 2000 bubble. But outside of that, we're much more elevated than recent history. So what does this mean? This means like, hey, how crazy are the stocks moving right now, right? Okay, we're not at the stock market internet bubble of the 2000s, but we're way above normal, right? So we're very concentrated. Correlation is low, which means that all stocks are not moving in sync, right? When correlation goes to 1, it means all stocks are going down or all stocks are going up. So what does it mean when we have elevated dispersion and low correlation? That is generally associated with bubbles. Are we in a bubble right now? I think we're in a short-term bubble. So if you remember in April, we had over a 2-week period, S&P dropped 5% and NVIDIA dropped 20%, right? That's the sort of short-term bubble that I think we're in. So this is what we're calling intercorrelation, which is the individual components of the index are moving a lot and they are responsible for moving the index around so much, right? These 3 stocks dictate how fast the market is going up or down. This was the measurement from Wednesday, right? These 3 stocks, this is the impact that they had on the S&P 500. So you have 40 to 50 bips of the S&P's 1% move on Wednesday was due to just 3 stocks. Now, if you look at MasterCard, which was down 5% on the day, and some of these other names which just got crushed, because there's such a small weighting in the S&P 500, they can go to 0 and it doesn't really move the index that much. It's like, who cares, right? So when people talk about breadth, the part that they say is the psychological thing of, okay, great, breadth is not expanding. That's not great because psychologically all stocks should be moving up and why aren't they sharing in performance? And they're not thinking about the positional impact, which is you have this concentration, these few stocks move the market. The other issue with that is that this shows you the top stocks. So I included Tesla in this because it's such a big options trading name. 50, that's what this number is, to 60%, which is what this is, of volume in these top names is next expiration volume. I like to call that 0DT, which upsets some people. So what you have is 3 biggest names, $3 trillion market cap companies. They move 4 or 5% a day, which is freaking crazy. 50 to 60% of the volume in the option space of those stocks are next expiration flows, and they are same day flows, right? Now, how do I say that? This bottom line here is open interest. This is 10%. So less than 10% of open interest of these names is tied to the next expiration volume, even though 50 to 60% of the volume is in the next expiration. What does that mean? It's day trading. That's all it is. So you have these levered options trades, which is what options are, levered volume, extremely concentrated on day trading in the most concentrated names in the S&P 500. So you can trade all of these options on a daily basis against the S&P, for example. I'm sure there's some type of HFT, high frequency trading going on there. It leads to all these bizarre movements in these stocks. This is the only way to me that this sinks, right, is if NVIDIA, Apple, and Microsoft drop a bunch relative to the index and that weighting flattens out. And I think that, again, if we have a small reduction or small drawdown in the market, you get a big move down in NVIDIA, Apple, Microsoft, Tesla. That's going to jack volatility up, right? The VIX is going to jump, and the S&P is going to be down more like 5% instead of just being down 1-2% because these big, really concentrated stocks are dropping. So this is what we call the intercorrelation, right? It's options-driven momentum in these names that is making correlation go to zero. And then the other side of this I've talked about is when you have these stocks so concentrated in these index products, how much available liquidity is there, for example, in NVIDIA, right? Because NVIDIA is, whatever, 8 to 10% of the NASDAQ, 7% of the S&P 500, 25% of the XLK, 20% of the SMH. There's huge hedge fund holdings. There's a lot of retail people that own, maybe they own 50 or 100 shares. Good for them, right? But that stock that's not getting traded, right? That stock is like off the market. So what is the tradable float? How many shares are actually available to trade in NVIDIA? I don't think it's that much. So when you add a ton of options trading on and you say, okay, dealers and market makers, they got to start hedging these flows, right, with underlying stock in some capacity, they're going to buy the stock because they have to buy the stock, just like a margin call, right? They can't say, hey, I'm a value investor. I'm going to wait for my spots and VWAP over the next 5 days or right? No, they got to buy shares. They're going to buy shares, right? I'm going to go do it now. And that makes the movement of these stocks really jump around. So those are the dynamics here, right? You have options leverage that I believe has helped to drive the concentration of these three names. It keeps the concentration high. I think that the relationship of these three names to the broader market has gotten stretched too far. And again, if you look at this list, there's only 1 year that we've been more concentrated than this, and that's 2007. What's so interesting about 2007, you ask? Well, that ran up to the great financial crisis. I don't think this is the great financial crisis, but it is like a Volmageddon type scenario. And the argument it is, hey, Brent, Volmageddon, we had a huge imbalance in the short VIX products, right? And that imbalance finally unwound and it caused a big jump in vol. Well, I think it's this correlation that is the big imbalance. So let's just take a look at this. I think we premiered this chart in April and we've seen the Wall Street Journal and Schwab and others kind of copy it. And so I guess that's flattering. But this is the great financial crisis. We had 900 plus days without a 2% loss. Volmageddon, we had 350 days without a 2% loss. We are now at or near Volmageddon. This chart is a little bit old, like a week old. So we're right on Volmageddon, right? Very unusual. Now, the part that no one else posts about, and I've talked about this before, I know some of you have seen this, but I've been able to kind of like synthesize these thoughts lately, is how many days have we had without a 2% gain? Well, if you look at the great financial crisis, ironically, that's the number one day in the last period in the last 30 years, roughly. 600 plus days. What's the other one? Volmageddon. Interesting, right? So what does that tell us? There's no vol. The market does not move. Now, most of you already know the answer to this question. Drum roll, please. What broke our streak of days without a 2% rally? Give you another hint. It was in February of this year. Not fast enough. NVIDIA earnings. One day we had in the last year plus, I believe it is, we had 2% up move. That was when NVIDIA crushed earnings in February. After that one day, we have now gone another 100 days without a 2% gain. And that's, all right, you're cherry picking stats here, Brent, but if you just add these 100 days on, guess where we're at? We're at now another record period, right? So you don't see record this, record that, record this, record that, never seen this before stuff. That generally doesn't end. It in my 20 plus years of experience, I don't believe it ends unless we have some sort of drawdown. It does not have to be the great financial crisis. Volmageddon was like a 10% drawdown in the market, huge vol spike. A month later, S&P was higher than it was pre-Volmageddon, right? So we recovered. June of 2021, for example, we had Tesla split, Apple split, record call volume, SoftBank, blah, 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 blah. September crashed violently, and then boom, we rallied to all-time highs back into the end of the year. I think we're really at risk of this spasm, and it's exacerbated by the IWM move. So this was all intercorrelation. Why is vol so tight? People are selling S&P vol. We have zero DTE flow, which suppresses volatility. We have record positive gamma. All of that, right, suppresses how much the S&P can move, right? Just kind of grinds up, but it doesn't really move much. It's a very linear trend up versus single stock vol is going crazy. Let's put this into context. This is from the SIBO. This is the highest ever single stock vol versus index vol, okay? So again, record highest ever. Super interesting. Okay, do you have a point, Brent? I do. Let's keep going. Hopefully, I was expecting the participant rate to go to 0 as I started talking about this. We're doing all right so far. Okay, let's advance to the point. I did this chart. This is a correlation chart, and you guys might not be able to see this that well. Let me zoom in. That did literally nothing. There we go. All right. Okay, so this is from early last week. I did this, and this is against the Qs. This is the Dow. I talked about this in the recent webinars, right? The Dow is doing bizarre things. And if you look at Nike and Boeing and there's a bunch of other stocks that are just garbage and they're not doing very well. But those are the biggest companies in the United States, right? And therefore the world. They are not acting in line with the broader equity market. Odd. So the Dow correlation has really blown up. Notice IWM. IWM is in gold. It can do some weird things, as you could see historically, and these are small cap speculative stocks. So, all right, fine. It does some weird things historically, not as weird as the Dow. What you can see here is NVIDIA has now moved back in line with Apple with the Qs and spiders. So that relationship is normalized. Remember in June, we had the biggest NVIDIA call position, we've ever seen. It was like a huge anomaly. After June Opex, it totally snapped back in line, and now it's acting much more normal. So this is what, if you look at that relationship, this is historically what you see. This is the correlation between Dow, IWM, NVIDIA, et cetera. And what you see is that everything is positively correlated. It makes sense. Most stocks tend to go up at the same time. Yes, some go faster than others and blah, blah, blah. But okay, like IWM, Dow relationship, 86% correlation. If you look at NVIDIA correlation to IWMs, it's 56, not super strong, but it's positive. Look at over the last month. Now, this is again from early last week. And you can see that the Dow, for example, and NVIDIA inversely correlated, SMH and Dow inversely correlated, negative correlation between IWM and NVIDIA, a little bit bizarre relationships. Okay, so what happened in IWMs over the last couple of weeks? We covered it in the founder's note extensively. CPI came out, right? And it was very, very low. Not very, whatever. It was lower than people expected, and that suddenly everyone's like, separate cut. Odds of that spiked. And we had the largest IWM call volume ever. There's another largest ever. I've lost track of how many there are. And you can see that surpasses what happened in late 2023 by a milestone. We talked about this in the founder's note as well. Open interest didn't really jump that much. And so, to me, this has more to go. I'm getting to the point why this matters soon. So this is only year to date, right? Open interest. We're not even at any record highs in total open interest. So I think there's plenty more space to go here. It's a little early to want to jump in simply because implied vols, this is 1 month skew here as I covered in the founder's note, they're expensive. This cone is, 90-day range. We're obviously way above that at the moment. Even the at the monies are a little bit rich. I just think that most of the time when you're trying to buy into something like this, you're just paying too much. I didn't look yet, should have looked at a little bit longer dated, but right now, the idea that everyone should rush into small caps and you get record volume, that tells you that, hey, number one, that move has to get priced in, right? 5% in 2 days. So that affects call implied vols, and then demand also affects call implied vols as well. So you just got to wait for this to subside. Plus we're going into Opex, right? Wednesday Opex through Friday, which could just lead to a little bit of resetting, a little bit of pullback in IWMs. That's what I'm looking for. I'm looking for a dip to buy. Okay. Why does this matter for correlation and all that other stuff? Record call volume, elevated skew, all of that. All right. These are the same correlation charts that I made for, that we were just looking at, right? Where did those go? Okay. Now this is correlation with spiders. I realized at the 11th hour here that I should have just done a versus Qs like I did before, but it's going to tell the story anyways. This is the relationship of the spiders to IWMQ, Dow, etc. This is the IWMs now. There's now a negative relationship based on the last 2-3 days between the IWM small cap index and the S&P 500. It's not happened since 2020. It's not on this chart. All right. What you can see is that the Dow is still, pretty wonky. It's green, a little bit tough to see there. And then you can see the other things are fairly correlated. So this is very odd, right, to have this. And it's only been a few days, but I suspect that there's a theme coming here. The other one I have plotted on here, which you want to make note of, is TLT. That's the long bond ETF. It has become positively correlated with the market, which is weird because that's not usual. So let's advance and take a look at this in terms of these charts. You can see that historically TLT is mildly inversely correlated to equities. We all know that 60-40 portfolio, bonds down, stocks up, and vice versa. That's not weird. And again, all these other positive stock relationships we've talked about before. But look at what's happened over the last week. Now, the TLTs are slightly positively, it's not a massive swing, but they're positively correlated with, these other assets, right? Because of the shift in the yield curve, I guess, over the last couple of weeks. So that's a little bit weird. Okay. But look at the IWMs. They're 1-to-1 almost inversely correlated with the other stock indices, right? Semis, Qs, etc. Note the semis, right? So now we have this inverse relationship. I don't have the chart on here, but someone was posting a chart of how rare it is to have the Qs down on the day when you have such a big move up in the IWMs. The correlations are breaking. And I wrote in the founder's note that, look, this is not about a rotation out of equities. It's a intra correlation sort of shift because we're going from the most concentrated tech names into IWMs. And so we're doing that with options as well. So the point here is that I don't think that you can have a rotation into these semis, into the small caps, which seems to be what we're doing, without big pressure on possibly the mega caps, tech, and the S&P, which could invoke volatility because these big caps come down and they reset or normalize versus other things. If the rally is going to broaden out and we're going to rally in small caps and maybe even some of this Dow stuff as well, if Trump's going to be a infrastructure person or whatever, I don't even know, if the market starts to price that in, I'm not sure what those are. So what you're seeing is and to William's note here, what you see here is IWMs are now positively correlated to the rates because now that you're getting this rate relief, IWM, these companies that are struggling to survive, like, oh, we need better capital rates, and maybe this responds to REITs, and who knows what else. If we're going to get cuts initially, that's good for those companies. I don't know that rate cuts if the Fed has engineered a perfectly soft landing, and we don't get a recession, then I guess the IWMs can keep rallying, but. This is just another signal that these shifts are happening. And because these shifts are levered, right, these odd things are levered, options is the leverage part of this. I don't think you can have just graceful soft landing in adjustments in the correlation. So Annie here says, what's the trade? The trade that I thought was most interesting to do, and we talked about it a little bit before, was there's the equal weighted, and I meant to do the beta lookup on this, and I'm pulling up TradingView because I know how to show the correlations here. But you have like the RSP, for example, which is the equal weight index, right? And then you can pair that off against the S&P itself. And that would be one interesting way. So what you can see is the relative performance of this. Is this going to pick up and these other names broaden out and we start to rally? Or do you maybe go long small caps versus short tech? as another trade, right? And you could do that in option space where you could figure out the beta relationship of the two, maybe looking at correlation or something like that. Hey, I'm going to buy January IWM calls versus QQQ puts, or maybe I'll sell the QQQ calls to fund my IWM calls, right? You could do something like that. And there's a couple of different ways to play it that are pretty fixed risk, right? And so, does this broaden out as a signal that, hey, if you subtract these two or however you want to weight these two, you could really see things start to shift. But you can see this relative catch up, right? You could see that explosion there. That's a big jump in those two. So I think shorting this versus long that is a pretty interesting trade if this continues to trend. And what I would think what's happened is we have one sort of like spasm where, okay, NVIDIA, Apple, whatever, normalize, they come back to trend and things get kind of fixed. The way that I was explaining this to Jack Forehand on the podcast was, if you drew like a long-term trend line, or you say, hey, what's the 200-day moving average? I don't know how to quickly bring that up here, but in one of these products, or if we just look at Apple, right? What's like the 200-day moving average here? It's like, let's just say it looks like that. I don't know what it is. Let's just say it's that. Well, this is what I'm looking for, right? Not like this where we go to zero. It's this, right? We're and that's a 10-20% move. That's a big move, but we've done 20% in a month. So, this is the spasm I'm looking at. I think broadly, with Trump being a heavy favorite now, and again, not a political statement, I just think the market likes certainty. If he's the candidate, or if it's just going to be Biden, if one of those two comes through, the market I think is comfortable, at least in the short term, with either of those. They're going to be focused on rates coming down a little bit now, and who knows what happens post-election. We have a period now where there's a short-term excess which has to be reconciled, but that I think would be a buying opportunity into August, right? So, and this Opex week is a time for these positions to shift and some stuff to shake up. Now, this felt very, very clear to me, this setup for this Opex period. I really thought the timing was lining up. Trump odds jumping recently, and the rate cuts over the last 5 days between CPI jumping and rates coming down, as well as the Trump odds jumping. That to me seems to be, maybe it stays off a little bit, but this Opex window seems to be opening a chance for some of this correction. And if you look at what happened into Opex last month, we got a really big drawdown here, right? It didn't manifest into equities itself as much, but you could see here's a 15% drop rate on Opex on NVIDIA itself. It didn't spill over into Apple quite as much. Obviously, there's earnings and stuff coming up too, so it's a little bit of a crowded situation. The big takeaway here is if you guys are seeing, in my view, a big drawdown like in April, people are like, I don't know what's going on, and there's a lot of that. Hopefully this correlation lens and the options volume lens help you to say, okay, I get why we're moving down so violently in either these big stocks or the major indices themselves, and I can more effectively allocate maybe buying into the dip because I know that the move is being exacerbated by some of these positions, right? And what I would be looking for in the S&P is, I still stand on this idea that 5,600 is this risk off period. We're kind of chomping or turning a little bit below there. If we break 5,500, I know this question will come up, so if we break 5,600, there are still some pretty big positions down at 5,550, as you can see here, that are not really going to be much unchanged. And so, I think even down to 5,500, there's probably big support there. And unless we get a credit flare up, a macro geopolitical flare up, flare up, credit flare up, something like that, there's not a whole lot of reason to break below 5,500. So into Opex, a perfect scenario in my view is we pull down this 5,500, 5,550 area, and I'd be looking to maybe buy in that dip. But I think this equal weighting or IWM small cap may have more legs to it relative to the big cap. So that's how I'm looking at this thing. I will turn to look at questions. By the way, if you have questions, please put them in the Q&A section.